Hey, it's Tom here and welcome back to the channel. For the longest time, Phil Town has been a big influence in my own personal investing. He's been one of the people that helped me go from a complete newbie, beginner investor, took me through that journey of sort of learning how to invest in Warren Buffett, Charlie Munger style, to the point now where I'm confident in making my own investments. All of his books sit behind me in pretty much every video I make, and I still use his 4M checklist in pretty much every company analysis I do. So I'm really interested in following pretty much everything that I can from Phil Town. And about a year or so ago, he started a fund, the Rule 1 Fund, and that means that every year he comes out and writes an annual letter just like we get from Warren Buffett from Berkshire Hathaway. So in this video, I want to go through the latest annual shareholder letter from Phil Town for the Rule 1 Fund. I will also say up front that this letter does include Phil Town's portfolio of both stocks and options. I'm not going to go through that portfolio in this video because I have actually already covered that in another video, but that will be linked down in the description below if you're interested in checking that out. But for now, let's jump straight into Phil Town's 2021 fund letter and let me give you my biggest takeaways from what Phil Town had to say. And if you're interested in reading this letter yourself, I will leave a link down in the description to that as well. This one is a little tricky to find, so I have to thank Brad Kellner for sending this letter my way. It is tricky to find because Phil Town's Rule 1 Fund actually falls under a sort of umbrella company by the name of the World Funds Trust. So there's a whole lot of filings for all the different funds that kind of sit within that trust, one of which is the Rule 1 Fund. So this can be a little tricky to find. But Brad, if you're watching, I appreciate you sharing the SEC link to this particular letter on your channel as well. Now let's get straight into it. So the first thing just to note for this annual report and annual letter from Phil Town is that they do have a bit of a weird financial year going on here. So they're covering the period from 1st of April 2020 to the 31st of December 2020. So I believe that just aligns with when the fund actually started. It started halfway through a year kind of thing. And all the holdings that you will see in the separate video that I made, which again is linked down in the description below, will be as of the 31st of December. So that's just something to keep in mind. And the date in which this letter was written was the 5th of February 2021. So it's a month or so old now, but of course all the things in here are still very, very relevant. Okay, so the letter starts out by Phil Town firstly talking about the performance of the fund itself. And there's kind of a couple things in here that I find a bit weird, a couple things that are useful. So he starts out by saying, we had a good 2020. I'm happy to report that for the year ended December 31st, 2020, our first full calendar year, the fund gained 12% after fees and expenses, which is great. And we'll get into the full performance of the fund a bit later on. They've got the fund's performance versus the Dow and so on as well. So we'll get into that shortly. The second bit he says in this kind of introductory paragraph is a bit weird to me. Basically, he goes on to say that according to an analysis by Broadridge Financial Solutions, the fund placed in the top 9% of the 73 funds in the Morningstar category, multi-alternative, and number 2 in our peer group as identified by Broadridge. In addition, the fund substantially outperformed the peer group median return of 4.66% and the category median return of 3.55%. So that's a bit weird, I find. Phil Town does not manage money in the way that a traditional fund manager does. He's not fully invested, he's not super diversified, which he actually gets into a lot later in this letter about sort of his investment strategy. So Phil Town has sort of always managed his money with a sort of hurdle rate in mind, and that hurdle rate is typically about a 15% per year return. That's kind of what he's targeting, and it is what he calls his minimum acceptable rate of return. If he's right on the business and buys with a margin of safety, he sort of expects to do a lot better than that even. But 15% is typically the threshold kind of return, and he basically doesn't put money to work unless he can achieve at least that. He then goes on to say, this year the excess cash in the fund that muffled our returns in 2019 did its job by lowering risk when the pandemic shut down, crashed the Dow in March 2020. It also provided the liquidity to buy a few businesses from our wish list that briefly went on sale. We definitely had our wash tub ready, as Warren Buffett suggested, in the event of an economic storm that will briefly rain gold. But the decision by the Federal Reserve to print money and by the President and Congress to quickly distribute it to desperate people and businesses, a decision we applauded, resulted in the market recovering as suddenly as it crashed. So, kind of interesting. I think a lot of people probably experienced this in March last year. Certainly I fall into this camp where I had a fairly significant part of my portfolio in cash at that time. I had the opportunity to buy into some businesses at that time, buy some stocks during sort of the March-April crash, but it happened so quickly and bounced back so fast that I really didn't get a chance to get fully invested at that time, nor did a lot of the businesses that are on my watch list go to the margin of safety price. There were certainly some. It was almost like there were two categories of stocks where some kind of quickly crashed down. Something that comes to mind for me is Facebook. It very briefly touched a margin of safety, but it was there for like a couple of days maybe, and then it just sort of ripped back upwards all of a sudden. So a lot of people, myself included, sort of missed that opportunity actually with Facebook. It's something I never actually pulled the trigger on. But there were another category of stocks that seemed to go down and kind of just stay down for several months and have maybe started to recover in the past just 2 months in early 2021. So interesting to hear that Phil Town had kind of a similar experience where he was able to pull the trigger on some things but not so much on other things just because of the speed at which things happened in March. And also because of some of the sort of government intervention and so on, which, if I'm reading between the lines here, he thinks had to be done, but certainly from an investment perspective, it probably got rid of a lot of the potential opportunities that might otherwise have come. So to follow up on that, he says, while we fell short of fully loading up our portfolio in March, we didn't completely miss out. We bought several of our favorites on sale, and the soaring market benefited all of our positions this year, even with a substantial amount of the fund still held in cash to hedge volatility. So if you've watched any of my previous Phil Town portfolio updates, you'll know that one of the highlights of those updates is always seeing how much Phil Town has in cash. And from the last update, which will align with the holdings that we'll see in this letter, Phil Town's portfolio was about 30% or so cash. So he's still got a lot of cash sitting in the portfolio, and that sort of smooths out a lot of the returns. So when the market goes down a lot, that cash kind of pulls the average performance of the fund relative to that index upwards, because the cash doesn't, suddenly go down 20 or 30% like a stock market index might. But at the same time, when the market is ripping upwards and the cash is earning nothing, it means that the fund struggles to kind of keep up. So it sort of hedges out that volatility. That's kind of what Phil Town is saying here. He then went on to quote his 2020 letter, in which he said, over the next 18 months, I think it likely that the market highs will get lower and the lows will get lower until it becomes clear that it will not rebound anytime soon. And then everyone who needs their money anytime soon will get out and the market will find a bottom. So that's something that he said in his 2020 letter. He kind of gives his thoughts on, what he said back then next up. He said, as of writing, the Dow is up only single digits from last January, but the impact of the pandemic, civil disturbances, and the summer and fall, massive money printing, and the ongoing payments of trillions of dollars directly to pandemic impacted small businesses and individuals has altered my view of where the market may be going in the short run. These policies may have the effect of driving the market up higher and for longer than I thought last May. Now, the next bit of the letter that I found really interesting is when Phil Town went on to talk about how he's looking to buy businesses that he describes as anti-fragile. So things that will actually get better when there's disorder and dislocations in the stock market, essentially. And he then went on to give basically a 6-point checklist for businesses that meet that anti-fragile criteria. He said that a wonderful anti-fragile company looks like to us: 1, simple and predictable; 2, durable competitive advantage; 3, high free cash flow; 4, low debt; 5, high return on invested capital; and number 6, the CEO has integrity and talent. And then basically he went through an example of one of the companies that he felt met all of these criteria, and he was able to buy at what he believed was a margin of safety at the time when he pulled the trigger. And that company is Boeing. So let's go through and have a look at what he said about the Boeing company. He says, we bought Boeing for the fund after the shock to the company from the grounding of the 737 MAX. They fired the CEO, and the mess created by previous management in one of the most iconic companies in the world certainly brings to mind Buffett's quip. And that actually refers back to a previous part in the letter that I skipped over a little bit in this video, which was a quote from Buffett where Buffett basically says, I try to invest in businesses that are so wonderful an idiot could run them because sooner or later one will. So that's what Phil Town's referring to with Buffett's quip. He said, we thought that, and again, this back to Boeing, we thought that the business was plenty wonderful enough to survive previous management. Then came the pandemic and the shutdown of the airlines, and suddenly low debt became huge debt, about $50 billion. But Boeing still had 737 MAX orders worth over $350 billion, and still had the durable competitive advantage of a worldwide duopoly for the construction of passenger aircraft, and we believed Boeing's new management team would build a bigger and more productive business in 10 years. As the price of Boeing stock dropped towards $100, we noticed that Boeing was one of just a couple of trusted defense contractors for military aircraft, and that cash flow from that part of the business was thriving and worth almost $100 per share. We could buy an anti-fragile defense company and get the commercial aircraft business for free. We bought more, and now Boeing is one of the larger positions in the fund. So really interesting. You don't often see Phil Town dive into his thoughts on specific companies. So to see him dive into Boeing like that and say, you know, Boeing's basically got the military aircraft component and the commercial passenger, you know, aircraft component of the business as well. He thought he was buying one at a reasonable price and basically getting the rest of the business for free. Really interesting for me to see those insights from Phil Town. He then went on to talk about actually a second company that is in the Rule 1 Fund portfolio, or at least was pre this update, and that is actually Seritage Growth Properties. So he basically talked about Seritage Growth Properties in the context of risk versus volatility. He basically explained that the academics in the stock market basically believe that the volatility of a stock explains the risk, whereas Phil Town views risk as buying something for less than it's worth being lower risk than buying something for more than it's worth, more than its intrinsic value. So he used Seritage as an example of that after sort of sharing the overall fund returns, which I'll put up on the screen here if you're interested in seeing that. He said Seritage SRG is redeveloping empty Sears stores. Buffett bought 5% of the business at $35 per share, and Berkshire is financing the construction. In February 2020, SRG was selling for $38 per share, close to the price Buffett paid. In March, the price dropped to $7. If we want to buy it, is it more or less risky for us to buy it at $7 in March than at $38 in February? We believe that the 80% drop in the stock price made the business more attractive to us, not less, because it provided us with a large margin of safety, so we bought it. With the market soaring and the end of the pandemic in sight, SRG stock ended the year at $14, and I think it's something like $22 or $23 now even. When we get it right, the market often quickly corrects the mispricing and the stock price goes up. When we get it wrong, we know that buying a business with a larger margin of safety leaves us in a much better position than buying without one. This seems hardly open to debate, yet there is an academic argument that the company was safer to buy at 38, and this kind of goes back to the volatility equals risk kind of argument. They believe in the efficient market theory that says that SRG must be riskier at the lower price. Seth Klarman, billionaire manager of the Bellpost Fund, wrote, Buffett's argument has never been addressed by the efficient market theorists. They evidently prefer to continue to prove in theory what was refuted in practice. Okay, so the last part of the letter that I want to touch on was basically how the mutual fund industry has categorized the Rule 1 Fund. They have to basically take different funds and put them into various categories to describe their investment strategy. And the Rule 1 Fund one is kind of hilarious to me. So it basically says that they were described as focused, deep value, contrarian, event-driven, macro, technical momentum, volatility, and derivative trading fund. So a whole lot of stuff going on there. And it turns out that these categories are actually pretty accurate for what the Rule 1 Fund does, even as much of a mouthful as it is. So Phil Town basically spent about the next page or two of the letter, the last part of his letter, going through what each of these different things means, at least in his mind, and how the Rule 1 Fund kind of behaves in certain situations. So The first thing he talks about is being contrarian, and anyone that's followed Phil Town will know a whole bunch about this already. Many of the basic ideas from Phil Town about making money in the stock market are very simple. They're about buying low and selling high, and basically that is actually quite a contrarian thing to do. So often when prices are going up, that means more and more people are buying. That's a time where someone like Phil Town is actually selling or sitting in cash when stocks are going down, and a whole bunch of people are getting scared and selling out. That is a time where Phil Town is putting cash to work and buying companies at a margin of safety. So that's what he described as contrarian. He then talked about being event-driven and investing on volatility. And going back to the pandemic is a very good example of this, going back to March or April last year. So he said that events that result in market drops happen with such regularity that Ben Graham, Buffett's mentor and the father of the Rule 1 strategy, considered these stocks to be normal fluctuations in the market. He then went on to say, the funds that invest as the market moves quickly down or up are categorized as investing on volatility. When events and volatility occur together, they set the stage for the fund to possibly become an aggressive buyer. So when a bunch of companies are getting to a margin of safety, he's buying a whole bunch of companies. That's basically what they mean by volatility and events driven. The next thing was about deep value. So he said when a major event like a pandemic shuts down part of the economy, there is a significant downward volatility in the market. And then moving forward a bit, he said, waiting to buy until the price is extremely low compared to what we believe to be the real value of the business is a discipline of Rule 1 investing that Wall Street calls deep value. Next up, Phil Town said, when we buy, we only want to buy businesses we understand. Getting to that level of comfort with a business requires a significant amount of study that cannot be delegated. Therefore, being human with only 24 hours in a day, we must limit the number of businesses the fund owns. We believe that something in the range of around 15 businesses is about right. And basically he goes on to say that's what the industry describes as focus. So they're not super diversified across a large number of companies. They're buying a handful of companies or 15 companies at most that they understand very well and that, again, they can buy at a margin of safety price. And the final bit of Phil Town's strategy, where they were categorized as macro, technical, and derivative trading, was basically about many of the in-between times. The times where the stock market is not getting beaten down and prices aren't at margin of safety levels. He says, there are times, however, when we believe the market is not overpricing companies we own and nothing we can buy is on sale. So it's kind of in the middle. It's not overvalued, it's not undervalued. In fact, that is more often the case than not. We adopted option trading strategies in these in-between times to increase our cash flow using proprietary macro and technical signals. These Rule 1 strategies for cash flow are called macro, technical, and derivative trading by Wall Street. And again, I will put up a screenshot here if you want to see Phil Town's options portfolio. Typically, he's writing put options on a lot of these companies. So these are actually really useful to try and see like a strike price at which he would be willing to buy these companies. So again, I'll put that up on the screen here. Don't just copy that and buy those stocks at those prices or anything. But that is currently what was in Phil Town's options portfolio at the 31st of December. So there you have it. That is a brief summary of Phil Town's annual letter to his Rule 1 fund investors. Again, if you want to read the full letter or see Phil Town's portfolio, that is down in the description below. If you enjoyed the video, please hit like and hit subscribe. It does really help me out and support the channel, so I would very much appreciate that. But that's it from me today, and I will see you in the next one. Cheers.